Hi there, it's Friday the 8th of May 2020. I'm Steve Towers. Welcome to ITB. Let's get started. As you know, the last ITB video was on the 24th of April, which is 2 weeks ago. There are a number of important stories which emerged during the first week. I've included those stories in today's video, but to distinguish them from this week's stories, they're marked as catch-up stories. There are 4 global developments to report this week in regard to the tax aspects of COVID-19. The first is that Pascal Saint-Amand has indicated that the OECD and the Inclusive Framework will be working on developing guidance for the novel transfer pricing issues which have arisen during the COVID-19 crisis. For example, trading losses made by low-risk distributors. He made these comments during this week's OECD Tax Talks webcast. If you'd like to watch a replay of the webcast, please go to our website or app. The second development is that the OECD has released a new version of its database which contains tax policy and administrative measures implemented by specific countries in response to COVID-19. For the link to the database, please go to our website or app. The third development is that the commencement of trade through the African Continental Free Trade Area, which was scheduled to start on the 1st of July, has been postponed indefinitely due to COVID-19. And the fourth development is that several commentators have started to discuss the significant increases in taxes, both higher rates and new taxes, which they expect will be implemented by many countries in the future in order to fund their huge budget deficits resulting from COVID-19. In this week's OECD Tax Talks webcast, Pascal Saint-Amand emphasised that the timetable for delivery of a consensus-based solution on digitalisation to the G20 has not changed. The end of 2020 deadline remains, despite strong lobbying by business groups to push back the deadline. However, due to COVID-19, the physical meeting of the Inclusive Framework, which was scheduled for early July in Berlin, has been changed to a virtual meeting, which he acknowledges will not be as effective as a physical meeting. A possible physical meeting in early October is being considered. And 2 more countries are pursuing unilateral digital taxes, Poland and Brazil. I discuss both of these developments later in this video. There have been 3 developments in the world of trade worth noting. Firstly, the USMCA, which will replace NAFTA, will enter into force on the 1st of July 2020. Secondly, the US and UK have started negotiations for a free trade agreement. And thirdly, according to the US Trade Representative, the US is now in full compliance in the WTO Boeing dispute with the EU, following the repeal by Washington State of a tax incentive. In Australia, the federal court has decided another deduction case in regard to the capital versus revenue expenditure issue. This case concerns payments of prepaid rent at the start of long-term leases. The court held that the amounts paid were capital in nature and thus non-deductible. For a copy of this case, please go to our website or app. In China, the government has announced the extension of the 15% preferential enterprise income tax rate for qualifying enterprises in the Western region. The 15% rate was set to expire on the 31st of December 2020. Under the announcement, it has been extended to the 31st of December 2030. For a copy of the announcement, please go to our website or app. In Hong Kong, the tax authorities have issued guidance in regard to the use of fair value accounting in the computation of assessable profits for profits tax purposes. For a copy of the guidance, please go to our website or app. In India, the Supreme Court has decided a case in regard to the PE definition in the India-UAE Treaty. The taxpayer is a UAE company. It carries on a remittance business. Its customers are non-resident Indians who wish to remit cash from the UAE to India. The taxpayer opened several liaison offices in India under approval given by the Reserve Bank of India. That approval restricted the liaison office activities. Importantly, the liaison officers were not permitted to have direct interaction with customers. The issue in the case was whether one particular activity undertaken by the liaison officers fell within the preparatory or auxiliary character exception in Article 5.3e of the treaty, which is in the same form as Article 5.4e of the 2014 OECD Model Treaty. That activity comprised these steps: downloading of data from the taxpayer's server in the UAE regarding the amounts to be remitted and the details of the recipients in India, printing checks and drafts drawn on Indian banks, and dispatching those checks and drafts to the recipients in accordance with the instructions of the NRI customer in the UAE. As you might expect, the court had no difficulty in concluding that the activity did satisfy the exception in Article 5.3e. For a copy of this case, please go to our website or app. Also in India, the Supreme Court has decided an interesting case in regard to the applicability of the mutuality principle to an onshore cost contribution arrangement for advertising, marketing, and promotion expenditure. The taxpayer company is a 100% subsidiary within the franchisor group for KFC and Pizza Hut outlets. The taxpayer was formed to act as a non-profit making company to facilitate the funding of AMP expenditure to support the brands in India. As part of a cost contribution arrangement, funds are contributed to the taxpayer by the various Indian franchisees and by the Indian franchisor company. The taxpayer then expends those funds on AMP initiatives with the objective of breaking even, no profit and no loss for each year. If, however, the taxpayer does make a profit in a particular year, the profit must be carried forward and used on AMP initiatives in the following year. Well, in a particular year, the taxpayer did make a profit, on which the tax authorities levied income tax. The taxpayer claimed that the profit was tax exempt under the so-called mutuality principle, which has been applied in numerous court decisions in India and elsewhere. However, the court held that the taxpayer did not meet all the conditions to qualify for the mutuality principle. For example, the taxpayer received contributions from a company which was not a franchisee or the franchisor. According to the court, those contributions tainted the whole arrangement, and therefore the tax authorities won. For a copy of this case, please go to our website or app. And also in India, a group of 9 business associations have called for the deferral of the new 2% equalisation levy, which has been effective since the 1st of April this year. For a copy of their press release, please go to our website or app. In Japan, the government proposals for tax law changes, which were announced in April, have now been enacted into law. The most significant change is the expansion of the scope of the existing 1-year tax loss carryback rule. In New Zealand, legislation has been enacted which introduces a temporary tax loss carryback scheme. Under this scheme, tax losses in 2 specified years can be carried back for 1 year, which will allow a refund of the income tax paid in that earlier year. For a copy of the legislation, please go to our website or app. In Singapore, the tax authorities have issued guidance on the income tax characterisation of subordinated perpetual securities. For a copy of the guidance, please go to our website or app. In the Czech Republic, the government has announced that the 4% real estate acquisition tax will be repealed, with retrospective effect from the 1st of December 2019. The European Court of Justice has delivered decisions in 4 cases. I'll quickly run through them. The most significant case is Dongyang, which concerns the issue of whether the existence of a subsidiary in an EU member state causes the parent company in a third country to have a fixed establishment in the member state for VAT purposes. The case concerns the LG Group, which had implemented a supply chain structure in Poland. Under this structure, LG Korea had 2 subsidiaries in Poland. The first was LG Poland Production, which performed toll manufacturing services for LG Korea. And the second was LG Poland Sales, which was the distributor of the finished goods in Poland. The taxpayer in the case is Dongyang, which is a Polish company which also performed toll manufacturing services for LG Korea. Those services resulted in the production of printed circuit boards, which were physically transferred to LG Poland Production for its use in the manufacture of finished goods for LG Korea. In regard to both toll manufacturing arrangements, all raw materials, work in progress, and finished goods were owned by LG Korea. When invoicing LG Korea for its toll manufacturing services, Dongyang applied a 0 VAT rate on the basis that LG Korea did not have any employees, buildings, or equipment in Poland. However, the Polish tax authorities took the position that LG Korea did have a fixed establishment in Poland, namely LG Poland Production, and that Dongyang should therefore have charged standard rate VAT. The court reached 2 conclusions. Firstly, the existence of a fixed establishment in a member state cannot be inferred from the mere fact that a company in a third country has a subsidiary in the member state. And secondly, a service provider such as Dongyang is not required to examine the contractual relationship between the parent company and the subsidiary, in order to determine if there is such a fixed establishment. For a copy of this case, please go to our website or app. The second ECJ case concerns whether Italy's financial transactions tax breaches the EU's freedom to provide services or the free movement of capital. The particular scenario considered in the case is the imposition of Italy's FTT on transactions involving derivative financial instruments, where the underlying assets are financial instruments issued by companies resident in Italy, and in the situation where the tax applies irrespective of where the derivative transactions were concluded and irrespective of the state of residence of the contracting parties and the intermediary. The taxpayer's first argument was that the FTT might discourage foreign investors from investing in derivatives where the underlying assets are governed by Italian law. The court rejected that argument on the basis that the FTT treats resident and non-resident investors in the same way, and thus there is no discrimination against non-resident investors. And the taxpayer's second argument was that the FTT results in administrative and reporting obligations in Italy in addition to those applicable in the state or states of residence of the contracting parties. The court also rejected that argument for essentially the same reason. The key issue is whether the Italian FTT discriminates against non-resident investors, and not whether administrative and reporting obligations are harmonised between Italy and other states. For a copy of this case, please go to our website or app. The third ECJ case concerns the interaction between the Italy-Portugal double tax treaty and the EU rules on freedom of movement and on non-discrimination on grounds of nationality. And although this case has nothing to do with multinational companies, it does focus on an interesting technical issue. The two individual taxpayers are Italian nationals who are resident in Portugal. They are both in receipt of pensions paid by the Italian government in respect of services previously rendered to that government. Articles 18 and 19.2 of the Italy-Portugal Treaty deal with government and private sector pensions. Those articles are in essentially the same form as the corresponding provisions in the 2017 OECD Model Treaty. The two articles don't deal with government and private sector pensions in the same way. In regard to private sector pensions, Italian tax is prohibited if the recipient is resident in Portugal. However, in regard to government pensions, Italian tax is prohibited if the recipient is resident in Portugal and is a Portuguese national. That extra requirement of Portuguese nationality, according to the taxpayers, breaches the EU's rules on freedom of movement and non-discrimination on grounds of nationality. The court rejected that argument. It said this: the difference in treatment which the taxpayers claim to have suffered arises from the allocation of the power to impose taxes between the parties to the Italy-Portugal Treaty, and from the disparities existing between the respective tax systems of those contracting parties. The choice of various connecting factors made by those parties for the purpose of allocating powers of taxation between them, such as, in the present case, the state responsible for paying the retirement pension and nationality, must not be regarded as such as constituting discrimination prohibited by Articles 18 TFEU and 21 TFEU. For a copy of this case and a press release issued by the court, please go to our website or app. And the fourth ECJ case concerns the calculation of VAT input tax credits for a business which makes both taxable and exempt supplies. In particular, it deals with changes to such calculations due to changes in the calculation method and to corrections. For a copy of this case, please go to our website or app. The European Commission has announced two developments in regard to state aid investigations. Firstly, the Commission has decided to extend the scope of the existing in-depth investigation of the Netherlands tax treatment of IKEA, which opened in December 2017. And secondly, the Commission has decided to launch an in-depth investigation into Belgium's tax incentives to support video game production. For information on both of these developments, please go to our website or app. In Hungary, the government has announced that companies will be able to deduct 100% of their taxable profits up to a limit of 10 billion Hungarian forints, which is about 31 million US dollars, if the profits are spent on investment projects in Hungary. For a copy of the government announcement, please go to our website or app. In Italy, the tax authorities have issued guidance on the country's patent box regime. For a copy of the guidance, please go to our website or app. In the Netherlands, the government has released for public comment a proposal to introduce a carbon tax to be effective from the 1st of January 2021. Public comments are requested by the 29th of May. For a copy of the proposal, please go to our website or app. In Norway, the government has announced a package of tax measures to support the oil and gas industry and the supply industry. For a copy of the government announcement, please go to our website or app. In Poland, Parliament has passed an amendment bill which, amongst many other things, will impose a 1.5% fee on revenue derived by large video-on-demand service providers. For a copy of the bill, please go to our website or app. In Sweden, the government has released for public comment a proposal to introduce a new dividend withholding tax regime to replace the existing dividend withholding tax. The government proposes that the law will enter into force on the 1st of January 2022 and will generally be effective on the 1st of July 2022. Public comments are requested by the 14th of August. For a copy of the proposal, please go to our website or app. In the UK, the Court of Appeal has decided a case concerning accounting rules for derivatives for UK corporate income tax purposes. The court held that although accounting rules are the starting point for the determination of taxable profits under UK law, the accounting rules must give way to any express or implied statutory rule, which was the situation in this case. For a copy of the case, please go to our website or app. Also in the UK, the government has reduced the VAT rate on electronic publications to 0, effective the 1st of May. This is 7 months ahead of schedule due to the increased consumption of e-publications during the COVID-19 lockdown. In Kenya, the amendment bill, which I covered in ITB on the 24th of April, has been enacted into law. You remember that the bill surprisingly omitted the reduction in the general corporate income tax rate for resident companies from 30% to 25%, which had been announced by the President on the 25th of March. Well, that oversight was corrected in the final act. That 25% rate is effective for the 2020 year. There's no change in the income tax rate for non-resident companies, which is 37.5%. In Israel, the tax authorities have released for public comment draft guidance in regard to payments made to a parent company under a recharge agreement for the grant of stock-based compensation. Public comments are requested by the 17th of May. For a copy of the draft guidance, please go to our website or app. In Pakistan, the government has abolished the capital value tax on acquisitions of various financial instruments, effective the 19th of April. In the UAE, the tax authorities have issued 2 items of updated guidance in regard to the VAT treatment of real estate transactions. For a copy of the guidance, please go to our website or app. In Brazil, a bill has been introduced into Congress to impose a digital services tax. The proposed tax would apply to revenue from advertising to Brazilian users or from making available a digital platform for the sale of goods or services if one user is located in Brazil. Its revenue thresholds would be global group revenue of 3 billion real, which is about 600 million US dollars, and Brazilian revenue of 100 million real, which is about 20 million US dollars. And it would be imposed with a progressive rate scale, starting at 1% and progressing to 5% as Brazilian revenue increases. In Colombia, the government has issued a decree in regard to the Colombian holding company regime. The decree provides detailed conditions for the regime, as well as information on documentation and procedures. For a copy of the decree, please go to our website or app. And Colombia has become a full member of the OECD. In Mexico, the government has published a decree which provides a tax credit to support hydrocarbon producers. The decree is effective from the 21st of April to the 31st of December 2020. For a copy of the decree, please go to our website or app. In the US, the tax court has decided a case in regard to the definition of foreign-based company sales income under Subpart F. The case concerns a Luxembourg CFC within the Whirlpool Group and its 100% Mexican subsidiary, which is treated as a branch under the US check-the-box rules. The Mexican company provided toll manufacturing services for the Luxembourg CFC. The key issue in the case concerns the characterization of the Mexican company for the purposes of the determination of the Luxembourg CFC's foreign-based company sales income, which is one of the types of tainted income under Subpart F. Should the Mexican company be treated as a branch in accordance with its check-the-box status? Or should it be recharacterized as a subsidiary under the so-called branch rule in Subpart F? The court concluded that the Mexican company should be recharacterized as a subsidiary under the branch rule. The court therefore held that the sales income derived by the Luxembourg CFC qualified as foreign-based company sales income. For a copy of this case, please go to our website or app. Also in the US, the Court of Appeals for the 8th Circuit has decided a case which concerns a structured arrangement designed to generate foreign tax credits. The court denied the taxpayer's claim for foreign tax credits under the US sham transaction doctrine. For a copy of this case, please go to our website or app. And also in the US, the Joint Committee on Taxation has issued a report which provides a technical explanation of the CARES Act. For a copy of the report, please go to our website or app. And finally, in the US, the IRS has issued 2 interesting items of guidance in regard to COVID-19. For a copy of both items of guidance, please go to our website or app. And it's been another slow week for treaty developments. All we've had is 1 treaty enter into force and 1 protocol enter into force. I have 2 articles for you this week. The first article is called The Signalling Function of Article 29.9 of the OECD Model, the Principal Purpose Test. It's written by Michael Lang and it's published in the IBFD's Bulletin for International Taxation. This is one of several recent articles which argue that the PPT should be viewed not as an independent anti-avoidance provision, but as a reminder that other provisions in the treaty should be given a purposive interpretation. The author writes this: the PPT does not represent a legal basis for denying treaty benefits. The provision merely emphasises the necessity for an interpretation based on object and purpose in those cases in which one of the principal purposes of a transaction was to obtain a benefit. The mere task of the PPT is to remind taxpayers, tax authorities and courts of the necessity of purposive interpretation in those situations in which it must be assumed that the intention is to explore treaty provisions favourable for the taxpayer to their limits. Consequently, the meaning of the PPT lies in its signalling function. And the second article is called What the CJEU's Hungarian Cases Mean for Digital Taxes. It's written by Ruth Mason and it's published in Tax Notes Today International. You'll remember the 3 Hungarian cases concerning Vodafone, Tesco and Google, which were decided by the European Court of Justice earlier this year. And you'll remember that commentators have suggested that the court's decisions in the Vodafone and Tesco cases have reduced the prospects for a successful challenge to the digital services taxes which are being implemented in various EU member states based on EU rules such as state aid and the freedom of establishment. Well, this article explores that very topic, and in particular, the issue of discrimination. And it's clear that the author agrees with the commentators. She writes this: Tesco and Vodafone lay the groundwork for rejecting fundamental freedoms challenges to DSTs. Although the CJEU did not expressly mention digital taxes in either decision, Advocate General Kokot extensively briefed the court on related DST issues. Moreover, the court staked out several positions that were stronger than necessary to reach the results in the cases, and instead can be most readily understood as being made in anticipation of EU law challenges to digital taxes. And she is critical of the court's approach. The court's decisions in Tesco and Vodafone might have been meant to strengthen the ability of EU members to discriminate against US companies, but in the process, they also strengthened member states' ability to discriminate against companies resident in other EU states. In laying the groundwork for rejecting challenges to digital taxes, the CJEU handed member states a set of instructions for implementing discriminatory taxes. It also signalled its willingness to ignore evidence of even intentional discrimination against out-of-state companies. Well, that's the way it is this Friday, the 8th of May, 2020. I'm Steve Towers. Have a great weekend.